Greetings and good morning, Ms. Hidayah. I'll be presenting on the impact of oil price shocks on Islamic financial market in Malaysia. So starting off with the introduction, the impact of oil price shock on Islamic financial market. This journal is by Muhammad Yahya Hussein, Fizli Muhammad Kamruzaman, and Nur Fakhzan Marwan and Azila Abdul Razak, published in the year 2012. This article focuses on the effects of macroeconomics factors and oil price shocks on the Islamic stock market in Malaysia. The goal of the study is to determine using an estimation of the vector autoregression, which is the VAR approach, the link between Malaysia's Islamic stock market and also the macroeconomics indices. Following next is this study examined monthly data from reputable sources from January 2007 and December 2011. The results demonstrated a correlation between Islamic stock values and some macroeconomic factors, including the price of oil. Moving on to the problem. In this journal, the problem was clearly stated. Similar to capital and labor, oil is a necessary ingredient used in the creation of products and services. Hence, a rise in its price would typically have an impact on the economic cash flow. Numerous economic factors, including costs of producing goods and services, the rate of inflation, consumer confidence, and financial markets may all be impacted by the increase in oil prices. Next is oil prices dramatically changed in the past 30 years. As you can see in the points given, decreased by 61% between December 2007 and November 2008. But suddenly, there was a drastic rise by 99% between December 2008 and November 2009. Moving on to the literature review. As for the literature review, the first point would be the fundamental idea behind many studies on this subject is that the projected cash flow and necessary rate of return affect share prices. As a result, economic factors like the price of oil are anticipated to have an impact on the share price as they might have future value, future cash flows, and the needed rate of return. Moving on to the capital investment, usually in the long term for the procurement of fixed assets and the purchase of shares and other securities for profits, suggests that oil price volatility has detrimental effect on stock price. Similar to this, notes that an increase in oil price has a negative impact on stock. Discovered to be adversely and strongly co-integrated with stock prices in 13 developed markets. Moving on to the last point, when local goods become more affordable, a decline in the value of the local currency will lead to an increase in export volume. As a result, the cash flow and the profitability of the business will rise, eventually raising the local stock price. As mentioned in the introduction also, that it is clear that the moving economy has direct effect on the changes in oil prices. Another important element have a favorable or negative impact on the stock prices is inflation. Inflation is thought to have a detrimental effect on stock prices. Moving on to the next point, this is because inflation will simultaneously raise the cost of production and reduce expected future cash flows and profits for businesses. Money supplies is said to be another important factor determining in stock price. The dual impacts of this variable are similar to the GDP and the inflation. Moving on to the design and procedures. First one is natural algorithm is one of the form used for all the variables, where A is an intercept and also R is a 7 times 7 matrix polynomial parameter estimator. L is lag length operator and variant matrix. Only the IIR variable in level rejects the null hypothesis of non-stationary at the 10% significance level, according to the findings of the ADF and PP unit root tests. At the 5% level of significance, the trace test and the max eigenvalue test results indicate that the variables are co-integrated with R4. Next is the data analysis and presentation. The data analysis and presentation. The IPI variable and the values of the FBMES have a positive correlation. This implies that the predicted share price will increase in direct proportion to the IPI. Additionally, the two factors considerable positive association supports the idea mentioned above. There is a large and positive association between the CPI variable and the price of Islamic stocks. This result is in line with the empirical results by Keel and Lee 2000 and Ibrahim 2001-2003, which showed a positive relationship between the share prices and inflation rates due to value of protection. This is through the hedging operation. Next, a positive relationship between, moving on is the presentation. That is, the results reveal a long-term statistically significant negative association between foreign exchange market and the Islamic share price. This research supports the existence of a positive and substantial association between the price of oil and Islamic stock market. Through the Watt test, a short-term Granger causal link may be seen. This is shown in the near term. The oil price and other macroeconomic variables have little impact on the return of the Islamic stock market. Only the inflation rate does. So in conclusion, according to the above, the mentioned empirical analysis, there is a significant and positive relationship between the price of Islamic shares and the economic growth rate, inflation, and price of crude oil, but a significant and negative relationship between the price of Islamic shares and the money supply, Islamic interbank investment rate, and foreign exchange. These results demonstrate that the importance of oil price and all macroeconomic variables in forecasting changes in Islamic share value. And in Malaysia, the oil price stock will thus have an effect on the return of Islamic stock markets over the long term, but not in the short term. That's all from me.
Good day. My name is Don Shakir, and I will be presenting an article review of the dynamic interaction between house prices and stock prices within Malaysia. So here is the contents of the presentation, where we will go through the critical review and the recommendation of the article. So with the critical review, we'll start first with its introduction and the problem statement of the article. So this article is studying the dynamic relationship between the house prices, interest rates, and stock prices within the Malaysian market, utilizing the co-integration and Granger causality testing. So the problem statement that is mentioned in the article is that there is a research gap for studies relating to house prices relating towards the stock market in developing countries. Most of the articles that are found in the journals are only for the developed countries, such as United Kingdom and US. So developing countries such as Malaysia does not have many studies done. The next problem statement is that there is growing interest in the real estate prices being linked to movement of stock price. This means that there is a higher demand for such studies in the academic area. And finally, the third problem statement is the findings of the relations between house prices and stock price is mixed, where in some countries there is a relationship between the two and while some does not. So finding out whether the relationship exists in the Malaysian market is important. Moving on, in the literature review of the article, cited sources of the research hypothesis of the article was based on developed countries. And as mentioned, developing countries did not have many studies done. So there were not many literature review of studies in developing countries. However, the article compensated the lack of literature found on this hypothesis by providing a review of the market movement of both the housing prices and the stock prices within Malaysia. It should be noted that cited sources of the research findings in the literature review were from outdated sources, where the articles range from the year 1984 to 2004, whereas the article was done in 2013. So moving on to the design and procedures within the article. So 3 variables were measured, and the data for the first variable, which is the house prices, was taken from the Malaysian House Price Index from the years 2000 to 2010, and these were secondary data. The second variable is the interest rate, where the base lending rate was used as a measurement. And finally, the third variable, the stock prices. This variable, the data was collected from the KLCI market within Malaysia. So the article's data analysis and presentation were divided into two, as mentioned in introduction. First, the data analysis was run through an integration order, where the variables were put through a standard augmented Dickey-Fuller unit root test and also the Lagrange multiplier unit root test. The second data analysis was through a co-integration and Granger causality, where the data was ran through an unrestricted error correction model, the Schwartz-Bayesian criteria, and the vector error correction model. And the results found that the hypothesis was supported, since there is a significant relationship between house prices and stock prices. As a conclusion to the article, the study of the article finds how house prices and stock prices are co-integrated within certain states of Malaysia. But the results show that certain states, both these variables integrate, such as in Penang and Kuala Lumpur. However, in other states, such as Perak or Terengganu, there were not any co-integration between house prices and stock prices. So the implication of these results is that it shows that the stock market takes center stage and is important in the stability of the real estate market, since in urban states of Malaysia, there is a relationship between house prices and stock prices. So for a recommendation for the article, we found one of the weaknesses of the article was that the hypothesis was unclear, and there was no future research recommendations at the end of the article. So we find it's important to provide a clear hypothesis, as it would help in giving a clear objective of the study itself. That's all for the second article. Thank you.